Most people think the stock market is unpredictable, scary, or even a little bit random. But the truth is, when you zoom out and look at the big picture, the market actually follows some clear patterns. In this video, I'm going to share the top 5 facts about the stock market that you should know before investing. By the end of this video, you will learn about the data that will help you understand the big picture movements of the stock market. But before we dive in, I remind you that past performance does not guarantee future success. The first fact is that the stock market and the economy are not the same thing. Many people confuse the stock market and the economy because they often move similarly. However, the main difference is that the economy measures what's happening now. Jobs, GDP, consumer spending, business activity. On the other hand, the stock market is a forward-looking indicator. This means that the stock market reflects investor expectations rather than the current economic environment. For example, the economy may be slowing down, but if investors expect the economy to improve, then stocks can rise, even if the economy is sluggish. Fact number 2. A 20% move defines bull and bear markets. Market cycles are defined by moves of 20% up or down from the highest point to the lowest point. This means you measure from a high point to a previous low point. Therefore, a stock index officially reaches bear territory when the closing price drops at least 20% from its most recent high. In a similar way, a new bull market begins when the closing price gains 20% from its low point. In this chart of the S&P 500, we can see that on the 29th of August 2025, the market closed nearly 30% higher from its lowest point in April 2025. This means that a new bull market has begun. Fact number 3. Bulls go bigger and longer. We have a bull market when the stock market increases more than 20% from the previous low point. The good news is that, in the past, bull markets have tended to be stronger and longer than bear markets. According to research from Hartford Funds, on average, bull markets have gained 115% and have lasted about 2.7 years, while bear markets have lost 35% and lasted less than a year. The data shows that bull markets have been getting stronger since the 1970s. Of the 27 bulls since 1928, the 18 before 1970 gained about 78% on average. The 9 bulls after 1970 gained 186% on average. Fact number 4. Both bull and bear markets are normal and common, but a bear market tends to be shorter compared to bull markets. The average length of a bear market is 289 days, or about 9.6 months. It's significantly shorter than the average length of a bull market, which is 988 days, or 2.7 years. Fact number 5. Bull markets are strongest out of the gates. This means that historically, the first half of a bull has outperformed the second half. This is based on data of 20 out of 27 bull markets. Please check the video description for the source of my data. The Hartford data indicates that about 74% of the time, the first half of a bull market rises more than the second half. Although the market has dropped recently, it has rebounded from the April 2025 low point. This suggests the S&P 500 could continue its upward momentum over the next 12 months. And being invested early could make all the difference.